what is the role of money? It's like you did a lot of work and now you want to save up your money so that sometime in the next 10, 20, 30, 40 years, you'll be able to afford to live. So you're storing economic energy. You could think of money as economic energy, just like you could think of fat as organic energy. You eat a lot, you store fat, and now if you have to go without food for 2, 3, 4 weeks, you're not going to starve to death.
Money as stored energy is the spine of Saylor's worldview, and it sets the stakes for everything that follows. If money can't safely carry your effort into the future, then every plan you make, education, family, retirement, slowly crumbles. Today's story tracks how he builds that case step by step, and why he believes Bitcoin uniquely fixes it. We'll move from first principles to consequences, then toward his prescription.
If you can't form fat cells, you're type 1 diabetic. A type 1 diabetic can't store organic energy, and they dwindle and they will starve to death. It's a just horrific disease. Being able to store fat isn't a bad thing. We think it's a bad thing, but actually for most of human history, right, the number one reason you died is you starved to death. So it seems pretty intelligent that when you get excess energy, you can store it and hold it for a while.
Saylor's analogy turns medical. When storage fails, the organism fails. Translate that from biology to economics, and a broken savings mechanism becomes a societal illness. The idea prepares us for his jump from individual metabolism to national currencies. When storage fails at the civilization level, the fallout is swift and brutal.
Now let's imagine a person as an economic diabetic. Where do you see that? In a society where the currency is collapsing, and hyperinflation, the Weimar Republic, famous example. So you work, I pay, in Zimbabwe, they had it. In Venezuela, they had it. In Nigeria, they're getting it right now. You work, I give you $100, and the $100 buys you 4 meals, but then in 3 months, it buys you 1 meal. And then in 12 months, it buys you 1 soda. And in 24 months, it buys you nothing. Okay. So now you've got a problem. You can't store economic energy.
Here, the metaphor becomes lived experience. Collapsing currencies erase the future by shrinking today's wages into tomorrow's crumbs. He's not arguing about investment returns. He's describing survival. Once trust in storage dies, time horizons shrink, and people are pushed into desperate short-term behavior.
So what happens when the currency dies or the money dies? Well, the society gets ripped back to Stone Age barter. What it means is you can't save anything. And also it means that the unit of account breaks down, so you can't trade. It's like, okay, you have bullets and I have soap. How many bars of soap for bullets? And how do you figure that out? Give me a chicken and I'll give you, a bottle of water. Mm-hmm. Things get very complicated. The civilization just gets ripped back to Stone Age barter. When that happens, all the factories break down. Like imagine trying to trade with your friend for dentistry work. Or, you just be your own dentist. Try that one. Be your own doctor. Take out your appendix.
Barter isn't quaint. It's catastrophic. Without a reliable unit of account, coordination fails and specialization collapses. That's Saylor's warning shot. Monetary breakdown isn't about spreadsheets. It's about losing dentists, supply chains, and modern life. The next turn asks what happens even when money still works, but only for a little while.
So the money breaks down, the civilization breaks down. That's the danger. But normally in most modern societies, the money doesn't break down as a medium of exchange. It breaks down as a store of value. So that means that, you can store money for 12 to 36 months or maybe up to 10 years in the dollar. You can't store it for a lifetime. So if you have some money, you can't just store the money. If you want to keep your economic energy, you have to gamble it or invest it. You have to speculate with it, or You know, you worked your entire life, you have a certain amount of retirement, and now if you store it in the bank, it'll be worth nothing. So you have to go and invest it in the stock market. But if you pick wrong, you lose it.
This is the pivot from collapse to quiet erosion. Even without hyperinflation, the long arc of savings bends toward loss. Ordinary people are nudged into casinos they never asked to enter. That nudge, Saylor says, isn't a bug. It's the downstream effect of money that leaks.
So we basically force people to be gamblers, speculators, or hedge fund managers if the money's broken, and the money is broken. So what is the significance of Bitcoin? Well, let me say it a different way. You just take your money, take everything you earn, you buy Bitcoin, and you wait, and it goes up 20 to 40% a year forever. Or you take your money and you invest it in a bank account and you get 3% after tax, and everything goes up 10 to 15% a year in price, and you just get poorer and poorer.
Saylor states the claim in stark terms: opt into an appreciating monetary network, or bleed slowly in fiat terms. Whether one agrees with the numbers or not, the structure of his argument is clear. The choice is between passive debasement and a savings technology designed, in his view, to outrun it.
Or what are you going to do? Buy GameStop at the right time? Are you buy a building, run an Airbnb? I force you to go, and forcing you to be a hedge fund manager is horrifically inefficient for the society. It's just as inefficient as saying, okay, be your own dentist and doctor, right? If the medical system was broken, you have to be your own doctor. It's not good for society. What happens? People die 20 years early is what happens.
The inefficiency argument widens the lens to the social level. When everyone is compelled to speculate, productivity and well-being suffer. The contention is not merely moral, but economic. Misallocated attention and risk-taking degrade the commons. A monetary fix, then, would restore time and reduce systemic error.
So Bitcoin actually solves the problem by saying, well, what if you just had a money that the government couldn't debase, the bank couldn't steal, that would last forever? Okay, it profoundly changes incentives, because now a corporation, instead of buying back its stock or instead of dividending out its cash flows, would just keep the money. And the money would go up in value 20, 30% a year. So that's what MicroStrategy did.
Here, he shifts from theory to corporate practice. Holding an asset that appreciates changes capital allocation, discouraging financial engineering, and rewarding patience. In Saylor's telling, Bitcoin realigns incentives from short-term maneuvers to long-term compounding on a sound base.
What's our secret, right? We're just holding the money, and it's an appreciating asset. Let me try to make one more analogy that might help. It's like you're an athlete, your blood is carrying oxygen. Oxygen is energy. If you're an athlete, you need the oxygen to circulate, and you need the blood. So before your race, I show up and I say, well, conventional wisdom is I need to bleed you now. So I take a bunch of your blood, and now you run the race. And then next week before the game, I show up and I bleed you again. And what if I just bleed you every week?
The bleeding image reframes inflation as periodic bloodletting. If capital is the blood of a firm or family, constant leakage ensures underperformance or collapse. Again, the point is incentive design. Stop the drain and performance improves, not by heroics, but by removing the handicap.
When the government is telling you should use a currency, the currency is the blood of your corporation or your family or your civilization. When I'm inflating the currency, I'm bleeding the civilization. And in the extreme, if you do this thought experiment, if I just double the currency supply in a banana republic, and your company had whatever, $1 million worth of currency, but I double it and now it only buys half as much, and I double it again and it buys half as much again. You see, it's Now take it back to MicroStrategy. In 2020, we had 2,000 people working as hard as they could work to generate $75 million a year in cash flow.
With that, the abstract becomes arithmetic. Output can be heroic and still get neutralized by policy. For Saylor, Bitcoin is less get rich quick than stop going backward. The prescription is to change the monetary substrate rather than sprint harder on a tilted field. Across these moments, Saylor's narrative builds from biology to macroeconomics. Money stores energy, broken storage shortens horizons, society drifts toward barter-like dysfunction, and a leaking currency pushes everyone into speculation. His solution is a savings technology that, in his view, resists debasement and restores long-term planning for people and companies alike. Before we leave, one last image crystallizes his philosophy of adapting rather than rowing against the tide.
But there's this point where you're rowing 7 miles an hour and the current's 7 miles an hour, and then you're in the middle of the Atlantic and you horrifically realize you're going to die because you're not getting across, right? You're not going to make it. And so what do? You reach down, you pull up the sail. You can't row. You can't row against current. You put up the sail, you catch the wind and let the wind blow you. You're going to have to change the way you do work.
Do you agree that Bitcoin is the sail that changes our direction? Or is there another way to stop the bleeding without rewriting the rules of money?